Great. Can you see my screen, please? Are you able to see my screen? Chapter 7, Improving the Accounting System. Can you confirm me that you are able to see my screen, please? Yes, great, great. Okay. This chapter is about improving accounting system. So you have your accounting system as a business, whether this accounting system is um, suitable for your business. Does this accounting system it help you to improving your performance? Does this accounting system is able to preventing any fraud and error during the recording? Okay, so we're looking at the accounting system. What kind of accounting system do you have for your business? Okay, so the outcome of this chapter, and hopefully by completing of this chapter, you are able to understand and identifying changes or to the accounting system, then analyzing your accounting system. Probably if there are an issue with your accounting system, you can identifying, then analyze it, then you have to try to implement it and try to solving out the issues with your accounting system. So you have to think about the recommendations. So in this, for this chapter, so always you have to think about recommendation, because I uploaded a number of questions for you. So one of the question is obviously it asks you to providing your recommendation, to providing your opinion about accounting system for that particular case study, for the case study. So you have to justify a recommendation, um, uh, whether you're going to changing your accounting system or not. So you have to justify it, and that you have to persuading other peoples from the board of director of your business that your accounting system required to be changed and it need to be um, implemented, and obviously is corrected, because probably the accounting system you have right now does not um, uh, uh, suitable and does not meet demanding of your um, business. Okay, so this is what we are going to cover for today. So the overview of this chapter, the overview of this chapter is a reason for change. If you would like to making changes, so why you are going to change, you have to justifying your implementation. You have to you have to explain it to the board of director. um, for example, if you are a management accountant or financial accountant, or you are chief finance officer, or you are finance director of a company, and you are thinking about changing your accounting system or improving or upgrade it, the system, or you have a Sage, for example, you have a Sage 50 and you think Sage 50 is not good enough because your business growing and your sales are um, increasing, and so you need to changing your accounting system to a better system. So you have to justify these changes. And if you are a financial director, then you have to write a report to board of director, because changing accounting system does need funding, does require budgeting, and it require a proper justifications from the financial director. So it is not going to be just simple moving or changing your accounting systems. Okay. So if we're thinking about the reason for change, if you're thinking about reasons for change, usually um, changing in accounting system, it is going to be identified through number of weaknesses, So when you have a problem with your accounting system, for example, uh, some figure are going to missing, and you think it is you need a proper system to calculating your VAT in a better way to preparing a report, and you're looking for a system to calculating your depreciation in better way to allow you to have a better understanding. So that's why is obviously you need to make a change in your accounting as a business. Okay, so so identifying need for change is an obvious starting point, of course. So you have to identify why you want to change in your accounting system. So whether the existing system need to be recorded and reviewed, need to be replaced. Okay, so the process for the information diagram, okay, it is need a proper explanations. Okay, this can be then reviewed for the potential change issues. Okay, so furthermore, there is more analyzing tools is considered for the office procedure manual. Okay, so remember from last week we were focusing on ratio, and we said we a company or investor or stakeholder, they focus on ratio analysis because of um, to have a better understanding of a company's procedure. Okay, better understanding of the company's performance. So whether, for example, last week we are focusing on uh, information from your statement of profit and loss, and we focus on the statement of balance sheet or statement of the financial position. Then we compare these figures together. For example, we pick up revenue from the statement of profit and loss, and we pick up non-current asset from statement of financial position. Then we compare these two figures together. Okay, we compare these two figures together. Why we compare these two figures together? In order to understand as how much your non-current asset contributing to generating income. Okay, to generating income. Probably you have some sort of assets, fixed asset. You have a machinery in a department, but uh, is very often you are using this machine. Okay, so even you investing in the machine says for £2 million, and this machine is making a little contribution for the revenue. Okay, so that's why we were focusing on the ratio last week. Again, today's chapter is about having a proper accounting system in order to analyzing and in order to help you to understand what is the association relationship between these figures. For example, you have a current assets and current liability, and you need to understanding the relationship between these two parts of your document. Or probably you need to have an accounting system in order to preparing uh, statement of the financial position and statement of the profit and loss in a more standard way. Remember, remember, end of the day, I think you learn from Sage level 2 how to preparing and how to preparing and printing out your profit and loss statement, how to preparing and printing out statement of the financial position. So that's what we did at level 2 Sage. So we recording our data, we recorded our invoices, sales invoices, purchase invoices. Then we recorded all costs. Then we record the depreciation. Then at the end, we're printing out our statement of profit and loss, and we're printing out our statement of the financial position. So remember, preparing statement financial of position or statement of the profit and loss, most of the part is going to be done automatically by accounting system rather than by manual. So it is going to be a manual calculation. It is little bit. Manual preparation is going to be not much. It's a very few compared to the. Please let me know if you have any question. Let me know if you have any question. Okay. So this is the reason for changing accounting system. So there are a list of reason to changing your accounting system. Remember, the main reason for changing your accounting system to improve, making improve. You are not going to changing your accounting system just for fun, or you don't like it, or it is difficult to use, or difficult to understand it. Okay, you changing your accounting system to improve. Okay, making improvement. Okay, so reason for change, there are many reasons for an accounting system to have be changed. Okay, you need to understand all of these and able to pick up them out of your synaptic information in the assessment in the exam. So reason number one, reason for change probably is about regulation changes, VAT rules change. Okay, VAT rules change. Right now, due to Brexit, so since a UK left the EU, so there is some goods is going to be have an impact in relation to the VAT. So a regulation regarding VAT is going to be changed between UK and EU. Okay, so for that reason, you need to changing your accounting system. Okay, you need to changing your accounting system. Okay, so this is one of the reason for the regulation change. Due to the regulation change, so obviously you need to, such as a changing in the VAT, and obviously you need to improving or upgrading your accounting system. Okay, second one is growth. This is a really important growth. So growth is sometime if your business is growth rapidly, so probably you have an old system, accounting system. So the old accounting system is no longer able to handle your growth. So for that reason, you need to changing and upgrading your accounting system. So growth, it could be one of the reason. Okay, growth is going to be one of the reason. For example, if you go to Tesco or if you go to Asda, the system they have now is totally is now different compared to 5 years ago, compared to 10 years ago. For example, now you have this scanning, self-scanning. Okay, it was not exist 5 years ago, 3 years ago. You have a self-service now. It was not exist in 2012 or 2010. Okay, so you can see is things is changing. I'm sure, because I used to working for Tesco when I was doing my undergraduate for as a part-time. So in the warehouse, obviously they had a system. It was an old system. They know how much they sold in the day and how much they require and how much they need to purchase. So, but now obviously they know by minute they know it by minute. So the people in the warehouse, they know what they are going to order. Okay, so you have a purchase manager and sales manager. Okay, so these two peoples are communicating together, and through the system, through the accounting system, they know which item they need to purchase. Okay, they know which item they need to make a discount against. Okay, so they do not make a discount just for fun. So obviously they have some sort of item, it is difficult to sell it. So in order to sell it, so then they're reducing the price and they make a discount. This is all is the accounting system. It allow you to understand, to analyze, to understand, to analyze. Okay. Furthermore, I'm not sure whether you heard about new information flow. New information flow. Basically, this is relating to the government introducing a new report of the requirement, such as the requirement relating to sustainability, requirement relating to actually is protecting environment and social. Okay, so these are is the information. So this information could be manageable through your accounting system. Okay, short-term capacity issues, for example a PC failure. So another reason for changing your accounting system, probably you have some PC, so the PC is the the amount of work you have, it is actually the capacity is not uh, capable to handle it on the same PC. So that reason, obviously, you need to changing the PC because the PC is unable to handle all the requirement and workload. So the capacity, another issue for changing your accounting system. Okay, identifying weaknesses, for example, need to introduce new level of authorization. Maybe you have an old accounting system and it is only allows one person to authorizing sales and purchase. And however, if you want to adding another person, okay, if you want to adding another person, or so that's why it is the system does not allowing adding another person to for authorizing sales and purchase. So in or that's maybe one of the reasons to changing your accounting system. Okay, in order for the environment. Okay, so these are a reason for changing your accounting system. Any question? Do you have any question relating to the reason for changing your accounting? Any question? No. Any question? Okay. Yeah. Okay, great. So, okay, we're going ahead. Okay. So now we have an idea why we are changing our accounting system. Okay. So justification for change. If you remember what I says you have to persuading your line manager and making a justification to board of director. If you are finance director, if you are finance director, part of the board of director. So when you have your meeting within the board of director, and obviously you have a proposal and you're preparing a report. Okay, so your proposal obviously is you asking to upgrading or changing your accounting system, and you must justify and you must have a reason. And you listed 1, 2, 3, 4 because of these points. So we need to changing our accounting system. So the changing in the accounting system, it allow us to have a better understanding of our business. Okay, okay, for operating of our business. So always a justification for change. Always you need to think about cost. You need to think about the cost. For example, cost benefit analyze, cost benefit analyze. Okay, so you have to think about one of cost if you're purchasing a system, software for development by a new equipment. Okay, staff dissatisfactions is if the system are poorly specified to implement. For example, if your computer, obviously this computer is going, if the more you use PC, the more slow it is going to be. If you are a manufacturing company, if you have a machine, this machine is going to be slow down, and is more problem with the machine. It's like a car. When you have a car, the more getting older, the more you drive the car, the more problem it will have. Okay, so this is again, it is going to be a reason for justification. So in here it says staff are not satisfied, staff are feeling not comfortable with the equipment. Okay, staff not feeling comfortable with the equipment. I remember when I used to working for NHS, part of the payroll and in the finance team. So we receiving a lot of phone calls asking about the mileage, about the payment, about the extra shift, and these kind of questions. So when some of our computer, it was very slow because it was old and take time to uploading, okay, new system, new screen, and it take time to handling each customer. Probably each customer take you 5 minutes, 6 minutes. Some customers take 10 minutes to solving their issues because of the computer is very slow and it take time to loading new screen. Then what they did in our department when I used to working for NHS, they're replacing our PC, and obviously each PC, everyone they got a new PC with a two screen. We had a two screen. In order we can open so many screen, okay, so many window in main time on two computer screens. So if you have a scene, there is a PC with a two screen in order to allow you to see more things in one time. So in order to do that, obviously you can handling one customer within reducing time within 3-4 minutes. Okay, just you click, 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 and you get everything is, and you can see it. Okay, so this is one of the reasons. So staff is not, obviously this is a reason you are saving time. You are saving time in here, reducing spending time on one customer, so you can handling more customer in proper ways. Okay, so that's one of the reasons to justifying your change if you are finance director. Then maintenance replaceable item. This is again is going to be relating to the replacing a PC. If your PC go slow down, it take time to uploading, and it is obviously is reducing your time. Okay, and you wasting a lot of time just to for the uploading. If you have a new system, just within a click, so it is everything is going to be uploaded. Okay, it is going to be uploaded. So opportunity costs, if we're looking at the opportunity cost, so opportunity cost also it is important because even you are investing in the equipment, but again Obviously, investing in the equipment, it is allowing, and you are investing anyway in the assets. So asset is going to be part of your company, and this asset is going to generating income, make a contribution to improving your incomes. So furthermore, if we're looking at the this is about the tangible cost, intangible cost. So then if you're looking at the tangible benefit and intangible benefit, so the reason I'm saying tangible and intangible is because some of these costs obviously can be seen. These changes is if you're buying equipment, you can see you have a equipment, but the tangible cost of these specify implementation stuff. Yeah, again, is some of these benefit can be seen and some of them is not can be seen. Okay, it's not exist. So saving in staff salary, maintenance cost. Okay, more informed, a quicker decision making. Okay, greater efficiency, improve customer service, as I says, while you holding customer on 10 to 15 minutes on phone. And obviously, if you can reduce a customer on phone within 3 minutes, 4 minutes, 5 minutes, okay, sorting out the issue, okay. Business benefit gaining through the improving management information. So obviously, the more better system you have, the better you can managing the informations. Remember, last week we were focusing on the ratio. So the ratio, it allow you to understanding what is going on, to understand the relationship between your assets and your revenue. How much this asset is making a contribution toward your revenue. If you have a good system, you can understand relationship between revenue and cost of revenue, cost of goods sold. You can look at your margin, profit margin. If you have a good system, it can calculate it. If you remember from Sage 50, from year 2, level 2, you are unable from Sage to calculating ratio. You are unable to calculating a profit margin from Sage. But obviously there are systems, for example, if you upgrading your Sage from Sage 50 to Sage 250 or Sage 500, then obviously you are able to do so many calculation. Okay. So gaining a competitive advantage, so you will become a better company compared to your competitive business, because you have a better system in place. You have the system is allow you to understanding your business in more detail, in more details. Okay. Okay, let us focusing on a new topic from this chapter about payback. If you remember, we say improving. This chapter is about improving the accounting system. Okay. Okay, then we decided to make a changes. We decided to improving the accounting system. In order to improving the accounting system, then we have to invest. We have to buying new equipment. We have to buying a new accounting software. Okay. So when we buying new accounting software, when we buying new machinery, okay, so it means we are investing in a business. We are going to investing in the business. As a business, you are not just going to investing in the business for no reason. You are making investment in the business to improving your company's performance, to improving your sales. to improving your profit figure. Okay, so now we're going to look at the way how this investment is paid back. If you're buying a machinery for £2 million, £200,000, and how long it take to pay back? How long it take to pay back? Okay, so the payback calculate the time taking the project cash inflow to equal project cash outflow. Okay, so we're talking about cash inflow and cash outflow. How much did we spend as a cash outflow? Money is went out. And how much is generating cash? Cash is coming in inflow. Okay. The decision rule is to accept the project that pays back most quickly. Pay back most quickly. So if you remember what I says justification for change. Okay. You are finance director. Okay. You have a proposal. Your proposal to buy a new machine. Okay. And the machine says cost you £1 million, and you take your proposal to board of director to discuss your proposal. And member of or your CEO, your chief executive officer of a company, ask you how long it take back to getting back our investment money. Okay, how long it will take back to getting back our money. So this is the payback in the project. So if we're looking at this example, it says we have a two project because the finance director is proposing for making changes. You have a two options. You say, for example, project A and project 1 and project 2. Okay. So it says, because you are finance director and you know, and before you go to the board of meeting, before you making your proposal, and you already spoke to the supplier of this machine, and you already have some details about cost of the machine. Okay, you already have spoken to the supplier about the new machine, how much it would cost, and you have your figure as a £200,000. The cost of the machine is going to be £200,000. Okay, this is the cost. Okay, this is the cost. So your requirement is, actually it says if we investing £200,000 in project A, this machine, it will make a contribution to our sales. It will make a contribution to our profit, and it will improving company's performance. It will helping company's performance. Okay, so you said as a finance director, you say if we investing £200,000 in project 1, we will get back our money in 2 years' time. We will get back our money in 2 years' time. This is cost money, it went out, cash outflow. Cash inflow is money coming in, money generating through your project, through your new machine. 100,000 in year 1, 100,000 in year 2. So it means it pay back. Project 1, it pay back within 2 years. It pay back within 2 years. Okay. And in year 3, only generating only £50,000. If we focus on project number 2, the cost is £200,000. Okay, so you can see the money inflow, cash inflow, obviously it is different compared to project 1. For example, project 1 in year 1 generating £100,000, but project 2 is only generating £60,000. It's only 60%, 40% less to project 1. However, in year 2, we can see project 2 is go up by 12% and still less compared to project 1. Project 1 in year 2, they're generating 100,000, but again, project 2 generating £76,000. In year 3, you're generating 50,000 for project 1, but in project 2, you're generating 90,000. In year 4, 37,000, but project 1 is 0. Okay, so you take this proposal to board of director. You take this proposal to board of director. You say, based on this information, obviously we have a 2 option, either project 1, either project 2. Which one is more beneficial to us? Well, both of them, they have a advantage and disadvantage. Okay, both of projects, they have advantage and disadvantage. Are you with me? Okay. So, for example, project 1, we can get our money back within 2 years. If we're investing in project 1, we can getting back our money within 2 years. We can getting back our money within 2 years. Okay. Within 2 years, we will get back all our money we invested in project 1. However, project number 2, it takes longer. It takes longer to getting back our money. So it takes 3 years. It takes 3 years to getting back our money. It takes 3 years. So after 3 years, we will get back our money. But obviously is more profitable project number 2. Project number 2, it is more profitable compared to project 1, because obviously is 130, 220, 257, so about 10,000-12,000 extra compared to project 1. Okay, compared to project 1. So the explanation is in here. It says project 1 has paid back at the end of year 2. At the end of year 2, project 1 can pay back. Project 2 does not recover investment until end of year 3, so we will get back our money after year 3. But using payback, project 1 would be selected, even though its total return is greater for project 2. Okay, so project 2 is more greater for return. Okay, does that help you? So in the exam, you will have a question relating to payback, to calculating payback. Okay, we will do one more example relating to payback. So if we thinking about net present value, did you study net present value before? Have you studied net present value before? Net present value. Did you study net present value before? No. Okay, basically is net present value. It is about the cash you have today and the value of your cash for tomorrow. Okay, net present value. So for example, if you have a £1 today, it is worth it than tomorrow. £1 of tomorrow. So the money you have today, it is the value, it is better than the £1 you have it tomorrow. Okay, so we're looking at, for that reason, we have to discounting any present value of our project. We have to discount it. So if we're going back to this example, okay, if we're thinking about project number 1, during year 1, project 1 generated £100,000, and in year 2 also generated £100,000. So within 2 years, year 1 £100,000, year 2 £100,000. Both these two figures are equal. Both these two figures are equal, but not in value. But not in value. The £100,000 in year 2, in terms of the value, is less than the £100,000 in year 1. Why? Why? Because the £100,000 we generated in year 1, we can take it to the bank and invest it. And says you invested at 3%. You invested at 3%. So it means this money is going to receiving some interest. We're making a profit of this £100,000. So by end of 1 year, when we are in year 2, obviously this £100,000, it is more than that, this £100,000, because we had a £100,000 plus the amount of interest earned, plus amount of interest we earn it. Okay, so plus the amount of interest we earn it. So excuse me, so we already earning £3,000 as interest. Okay, so that's why obviously the amount of the interest is, you have to think about the interest you're going to earn it. So that's why the money we have today, it is greater than the amount of money we have it in tomorrow. The amount of money we have it in year 1, it is greater than the money we have it, we will get it in year 2. Can you see? So for that reason, to getting good or getting accurate figure or very close value of the amount of money we will get it in year 2, so we have to apply discount. Okay, we have to apply discount. Since the £100,000 in year 2 is not equal to the £100,000 we had it in year 1 in terms of value, so for that reason, obviously we have to apply discount. We have to apply a discount rate. Okay, the discount rate is probably 5%, 7%, 8%, 9%, or 10%, or 11%. Okay, so there is a discount factor. We apply for discount factor. Okay, we apply for discount factor. So the discount factor, are you with me? Are you with me? Please confirm if you are still here. Great, great, thank you. Okay, so we have to apply a discount factor since the £100,000 from year 2 is not equal in terms of value £200,000 in year 1, so we have to apply a discount factor. We have to apply discount factor. So net present value is the method calculated the net present value of all project cash flow if net present value is equal to or greater than 0, the project should be considered as it return at least equal to the discount rate. We have to applying a discount rate. So to perform a net present value calculation, so we need to do the following step. Step 1, identifying future incremental cash flow. Future. We have to understand the future. Then step 2, we have to apply discount. We have to applying a discount cash flow. So they are in today's term. They are in today's term. Remember what I says? The £100,000 we generated from project 1 in year 2 is not equal to the 100,000 in last year, because the 100,000 last year you invested in a new project, or you just put it in the bank and you're receiving the interest, and for that reason the £100,000 you generated in year 1 already generating money, so it is going to be more than 100,000 in 1 year time. So for that reason, the £100,000 you generated in year 2, it is not equal to the 100,000 in year 1. So for that reason, we have to applying a discount. We have to apply a discount. Okay. So step 4. If the net present value is a positive, then it means that the cash inflow are worth more than the outflow. You can see the from the project is both of them is positive. Okay, it's both of them is positive, so it means we can go ahead with our planning. Excuse me. Okay. Let's look at example number 2. Excuse me, just 1 second. Okay, so if we're looking at example number 2, which is go back to example number 1. Okay, example number 1. So it says time is, we are starting with a 0. Cash flow, we investing £200,000. The discount rate we apply, or discount factor we apply, is 10%. Okay, 10%. So because it is year 1, it is the present value still going to be £200,000. Okay. This is remember, this is negative. Why it is negative? Because the cash went out investing in the project. Then in year 1, time, it means year 1, we're generating 60,000. This is based on project number 2. Remember, this is based on project number 2. Based on project number 2. Project number 2. So it says excuse me. So we have to applying a discount factor. So in year 1, it is generating 60,000, and discount factor is 0.909. How we get this figure? So there is a formula. There is a formula, okay, to apply that. Okay, so simply we can say the formula is, if I remember by heart, is 1 give me a second, okay, equal 1. If plus this is the formula. Okay, this is the formula. It means 1 discount factor. Okay. Okay, the discount factor. This is the way we calculate it. Just let me open window. Start. Okay, so the way we calculating discount factor, it is going to be the formula is obviously what is it? It says 1 divide 1 plus the discount rate. Okay, discount. Okay, discount factor. So 1 is the 1 plus the discount rate is 10%. It means 0.10. Okay, so it is equal to 0.9. Okay, this is the way, this is the formula of a discount factor. This is a formula of discount factor. Okay, this is a formula of discount factor. Okay, so it means 1 divide 1 plus discount factor. Okay, so it means 1 divided by 1.1. Okay, 1 divided by 1.1. Yeah, 1 divided by 1.1. Yes, yes, it is going to be equal to 0. Okay, so usually it asks you to using 5 decimal point. Usually it asks you to using 5 decimal point. Okay, okay, usually it says 5 decimal point. Okay, so you can see for year 2, obviously you can see for the year 2, just let you know, we will ending our session at 10:30. At 10:30, so we will ending our session at 10:30. So remember, I says the money you have today, it is better than the money you have it tomorrow. Why? Value of money of today is greater than the value of money you have it tomorrow. Okay, so if you thinking about it was the think about the housing price. Okay, okay, says 30 years ago, if you have a 60,000 pound, you can buy a proper house. But today is 60,000 pound is nothing. Even you cannot buy a flat. Okay, so for actual value, the present value of this 60,000, it is equal to 54,000 pound. Equal to the present value is going to be 54,000 pound, because we apply discount against that 60,000. Okay, is 54,000 pound the present value. Because after 12 months, remember, after 12 months we starting from 0. Month 1, 2, 3, 4, 6, 7, 8, 9, 10, 11, 12. Obviously you generating 60,000 pound, but the present value of this 60,000 pound is only 54,000 pound. However, for year 2, we know we're generating 76,000 pound. Okay, so how much is worth it, the 60,000 pound in year 2? Okay, in year 2, again 60,000 pound in year 2. Where I am, in year 2 is obviously is going to be a different rate. Why this different rate? Well, we have to, because it is time. It is time. Okay, it is time. Due to the time, the discount factor is actually decreasing. Why is decreasing? So just let me show you what I did. So obviously in here, the discount factor, should be powered by 1, should be powered by 1, should be powered by 1. Are you able to see my are you able to see my screen? Are you able to see my screen? Are you able to see my screen? So if you looking at here, so we apply a discount factor. So in here, so obviously we can apply a discount factor. So the discount factor is okay. So this is 1. Okay, if it is year 1, if it is year 1. However, if we change it for year 2, uh, yeah. Can you see what I did? We have to apply a power. We have to applying a power. Uh, this is for year 1. So for year 2, is going to be it is going to be like that. Then it is equal to 0.826. Okay, 0.826. Okay, can you see? Why is power 2? Because of time. Why is power 2? Because of time. This is power 1, this is power 2. Year 1, year 2. So you can see for year 3, it is going to be less. The discount factor is going to be less. Okay, so you can see here, obviously, 76 if it is cash flow, and the present is going to be 62,000 pounds. For year 3, again 90,000, then the discount factor is go down to 0.76. Why? Well, because of it is year 3. The more you go down, the discount factor is become less. The discount factor is become less. Okay, the discount factor is become less. Okay, and and for year 3, 1 divide bracket 1 plus 0.1 close bracket power 3 equal to that figure. Okay, equal to that figure. This is what we got it. This is the formula. Okay. You can see for year 4. You can see for year 4, obviously, it is again is going to be powered by 4. It means the discount factor is getting smaller. Can you see the discount factor is become smaller and smaller and smaller? Okay, it means 37,000. It is worth it only 25,000 at the present. At present, okay. So the net present value is going to be 10. Okay, 10,000 pound, only 10,000 pound. Net present value is only 10,000 pound. Is that okay? Is that okay? So it means only they're generating £10,000, obviously extra. This investment in the project number 2 is only make a £10,000. £10,000 net present value, as long as it is the positive figure, the net present value, so it will not be it will not be an issue. It will not be an issue. Okay, it will not be an issue. So let's move to cost estimations. This is another way for cost may be a difficult to calculating, and some estimation will be needed. There are different classification of denote and accuracy of the cost estimate. Definitive estimate aim to be accurate to within 5% and are produced after the design work is done. Okay. Feasibility estimate accurate within 10%. Comparative estimate, if you want to compare with the other people's, because you don't know how much it would be the cost. Okay, it is depending on the similar project and similar economic condition. Okay. And the last one, ballpark estimate, is going to be accuracy within 25%, but the definitive, it is the most one, which is a 5%. Feasible is 10%. Comparative, so it is going to be based on the economic condition, and ballpark is going to be accuracy within 25%. Because remember, if you are planning to investing in the business, so obviously in the first place you must have a business case. Okay, you must have a business case, and based on the business case you have to calculating your risk and the benefit of that investment project. Then you have to calculating the cost to board of director, to the person who is funding the project. So when you're calculating your cost, whether you're going to apply a definitive, visible, or comparative. Okay, so then it will give you an idea. Again, you can applying for SWOT. SWOT, it means strength, weakness, opportunity, and threat. Okay, for every investment, for every project, okay, you must apply SWOT. You must apply SWOT. If you are a financial director and you are thinking about investing in new building, investing in new machinery, investing in new department, first of all, you have to preparing your SWOT analysis. You have to preparing your business case. Okay, your business case. Your business case, obviously, people are invited to board of director. Okay, in the boardroom, you will defending your project. You will defending your project. This says the benefit of this project is 1, 2, 3, 4. The weaknesses is 1, 2, 3, 4. Opportunity is that, and the threat is that. Okay, so you have to proposing, and when you're proposing a investment or project to the boardroom, so you must have your SWOT analysis. Okay. So when we're talking about the implementing change, so you have to think about the job factors, social factors, personal factors. So each of them, they will have a revolve around it. Fear. What's the issue? Is a new technology. Are we able to handle it? Are we going to learn it very quickly? Do we have to go for the training? Do we have to inviting somebody coming to teaching us how to use? So always there are other considerations around the implementation change. Okay. Again, there is some other important uh, for the resistance, the need for the security and familiar, having opinion on changes. So obviously you have to asking the staff if you want to applying any changes in the business. Okay, so that's almost done for today. Okay, that's almost done for today. So I uploaded number of questions for you on Google Classroom. Okay, and I would like you to go through it and read these other questions. Okay, the other question: implementation for change, testing method, changing over method, and training. So when you apply for change, implementing change, so always you have to think about testing, whether we are capable to handle it. If you're bringing a new computer, new machine to the department, whether the current staff are able to handle it. So you have to test it. Okay, so changing over method, so I is going to be easy when we are changing. Okay, then you have to think about the training, whether the current staff able to handle new machine or they need additional training. Okay, so that's all for today. And what I need from you, obviously, I uploaded number of questions. Okay, between now and 12 o'clock. Between now and 12 o'clock, I would like you go through these 4 questions I uploaded. 1, 2, 3, 4. I think number 1 and number 2 is not that much difficult. Number 1 and number 2 is not that difficult. Please, please submit it. Hand in your question in order in the future if there is any issues. So you have 2 questions, each of them you have just pick up one of these 4. So I type it for you, the question, I make it easy. This is question number 1. Question number 2, it is multiple choice. Question number 2, it is multiple choice. Okay, question number 2, it is multiple choice, I think. Yeah. Okay. And question number 3. Question number 3, it is business case, and you need to write a task or writing email as a finance director to discussing a reason for proposal like a meeting. Okay, so you have to reading um, this business case. Okay, this is a company and you have they appointing new financial director, and the new financial director is need to writing an email or letter to discussing the new reason that the proposal is likely to be met with a resistance. Okay, it is interesting. In the exam probably we will have such a case study. Okay, this is number 3. And number 4 is multiple choice. Just select one of these answer. The question, it is not that difficult. The question is not that difficult. So only question number 3, it is a require writing. So 1, 2, question 1, 2, and 4, it is only multiple choice question. So for example, you say answer is A, B, C. Just select it and submit it. Select it and submit it. Okay. It's not that difficult. So it is 4 question, and I would like you to read that 4 question. Okay. And any more question? Do you have any question for me? Do you have any question? Okay, great. So I will see you at 12 o'clock. So between now and 12 o'clock, you must submitting your answer for those questions. Please submit your answer for the questions. So because I made a lot of effort to writing and setting up these questions, so in order to the head of school will see that you are engaging. This is only is for protecting you. This question, just make sure you are in these questions, okay? And I will see you at 12 o'clock, and thank you very much. See you at 12 o'clock, yeah, to discussing the question. So from 12 o'clock to 1 o'clock we will discussing the question, okay? From 12 o'clock to 1 o'clock we will discuss the question. Yeah, okay, yeah, great, Danish, thank you very much. See you at 12 o'clock, Jack. Please make sure you uh, the question, it is there. Are you able to see my screen? It is on the, if you go back to the Google Classroom, to this unit synaptic, and you will see the question that I uploaded. It is says on 3rd February, 3rd February, 3rd February, 3rd February. And it says question number, improving the accounting system, question 1, improving accounting system, question 2, improving accounting system, question 3, improving accounting system, question number 4. Okay, question number 4. Are you able to see it? It is here. Okay. Okay, see you at 12 o'clock.